Hello there, folks. Welcome into the three-piece. Three videos for me to react to in this one here today. First one up here, the big seven stocks won't survive with the valuations they have right now. Ed Yardeni expects a strong like Donkey Kong 2024. Want to listen to what he has to say there, react to that, and kind of give my opinion, so maybe a little bearishness, bullishness. And then, not totally risk-free, what bond investors need to watch. This should be a very interesting clip because right now, folks, in the bond market, it's not something I usually have to pay very close attention to. But I will say recently, I've been paying more attention to the bond market than probably all my 15 years of being in the stock market combined, because what's going on in the bond market has massive, and I mean absolutely massive ramifications for the overall economy, as well as for the stock market and stock market valuations. Okay, so that's I know usually we think like bond market, who cares? Right now, pay attention, okay? Pay attention. So you'll definitely want to watch that last clip with me. I appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed. New all-time high subscribers in the history of the channel. I think we're about to hit 35,000 in the next day or two. So I appreciate every single person for being here. Let's get into this.
The managing partner and portfolio manager at DCLA. He's also a CNBC contributor. I think it just trying to distill down what you're thinking, Surratt. I think the base case now is higher for longer, but what we don't know is higher than we are right now for longer, or where we are right now for longer. We still don't know. We could go a point or two, theoretically, 100 or 200 basis points higher before this is all said and done, depending on inflation and how strong the economy is.
Yeah, and I think that's what's causing a lot of this volatility, Joe, because the market's trying to figure out where we're going to go. And when it doesn't know where we're going to go, the first thing it does is sell. So you see that in interest rates, you see that in the volatility of interest rates, and then you add to it the uncertainty of other things going on, such as oil prices, the dollar getting stronger. And then, just because we don't have a government shutdown just means we kick the can down the road. And you could say the same thing about interest rates. So you add all that.
Wow. So basically the market, I certainly wasn't up at this time, but I guess the market going into the open was actually looking decent. And then it just tanked after that. Holy smokes.
Very powerful cocktail to say, hey, you know what? Why should I actually, in the short term, kind of be invested in the market when I can get 5.5%, 6% just sitting in treasuries? So I think shorter term, there's potential for much more volatility, but longer term, when this thing settles out, what we're seeing is a huge valuation disparity between the big seven and now the rest of the market. It's getting bigger and bigger.
Well, I wish we knew exactly.
So I think there's a few reasons for that, though, to be fair, on why we're seeing let's call it the big tech stocks have these bigger value, much higher P's are commanding than some of these other stocks. I think one way understated thing is, many of those companies have no to little debt. Outside of really Apple, Apple has a huge debt load, but for the most part, most of those companies are debt-free or very small levels of debt. And what do you want to be in this environment? You don't want to be debt-laden. You go underneath those stocks, and there's a lot of companies in this market that have, big debt loads, okay? Also, a lot of those companies are extremely cash-heavy and produce a lot of cash. Guess what's king right now? Cash is king. Why is cash king? Well, because we're getting like 5% on our money, right? Which is something we haven't been able to do in like 20 years. And also, assets are, let's just call it, much cheaper prices than they usually are at, right? Especially if you dig underneath the market, you even look to the VC space and what's going on there. We're talking about outside of like the AI related, let's call it companies that are coming up in the VC area. I mean, you can get valuations like 50% cheaper than you could even like a year ago, 2 years ago, 60%, 70%, like it's big numbers, right? So I do think that's another huge component that's probably not talked about enough.
What dictates further rate hikes, Surratt? If it was just inflation, that would make sense to me. You want to keep going up until you conquer inflation. But it almost seems like as long as the economy holds up, the Fed thinks that it needs to go higher. It's almost like a catch-22. To accomplish their goal, which is slowing the economy, they need to keep raising. And it hasn't happened. That's why the rates are going up now. Every strong economic number we get causes rates to tick higher with the notion that the Fed's not finished. Not whether inflation is strong.
Right. It's growthless. So we're back to the now good news is bad news, right? Because if you get strong economic data, it means the Fed is not going to take their foot off the accelerator. And that means higher interest rates, higher capital costs, and also for balance sheets that are weak to get even weaker. I think what we have to do is wait for the lag, right? And that's the hardest thing, to be patient, because they've started this months ago. And you are seeing some economic data that's coming in that's not as robust as it was before, but it's a timing issue. And then, Joe, we're going to go to the flip side and say, oh God, things are getting weaker when they start doing, and then what is the bottom, especially when you see pre-announcements coming, and whether that comes in advertising or it comes in labor or it comes in input costs. And look, at the same time, you have commodity prices rising too. So I do think sticking with really solid companies, balance sheets are really going to be important. And I think having a diversified portfolio in a time like this is even more important than just saying sticking with the winners. And I'll go back to the big seven. If we do get a slow...
I got to say, this is a very refreshing time for me, okay? Extremely refreshing time. Because if you know me, I always talk about balance sheets and preach about balance sheets and the importance of balance sheets, right? And if you've ever gone through my courses or anything like that, always preaching about balance sheets, okay? But here's the thing. For many years, a lot of people disregarded the balance sheet. They didn't care. Because we were in such a low interest rate environment, a lot of people are like, who cares if companies have huge amounts of debt and don't have any cash in their balance sheet and those sorts of things, right? And now, all of a sudden, everybody's starting to care about balance sheet. Oh my gosh, how much debt does this company have? Oh my gosh, look at interest rates. Oh, how much cash they have? Wow, they could get actually a great return on that cash, right? Oh, what if we go into a recession? What companies are actually going to make it through? Oh, guess what? The ones with strong balance sheets are going to make it through. And the ones with weak balance sheets won't make it through. So I got to say, it's a very refreshing time for somebody like myself that talks about balance sheets so often, because finally the masses are starting to have to pay attention to balance sheet.
The big seven are not going to survive with the valuations they have, even though their balance sheets are strong.
Interesting.
Would you be playing stocks?
The thing I don't like about it is he puts all these stocks in the same category. He says a big seven, right? Meta's got a very different valuation and growth profile than, let's say, Apple does, right? Amazon's got a very different growth profile and valuation than, let's say, Meta does, right? So I don't really like how they just group them all together and act like all these stocks are just going to go up or down the same, because it doesn't really work like that.
Would companies that would do well in a recession? I mean, are you starting to factor that in? So you're buying more defensive issues? I mean, we pointed out that, the Russell's down, that economically sensitive stocks have not been doing as well. Are they values now, or do you avoid them?
The Russell Wilson can't do freaking anything, man. It's ridiculous.
No, I think you have to look and say specifically, are you buying secular or are you buying kind of companies that are going to do well in a downturn? But I do think there's opportunities in healthcare and staples, companies like Haleon that will do well no matter what happens in the environment. Or you look at some of the utilities that are just being sold off because interest rates are going up. And at some point when that stabilizes, these companies still have core pricing. So, a company like AES that's down, 15% just in the last 6 weeks. So there are going to be opportunities. You just kind of have to hold your nose right now, because as we get this interest rate volatility, markets are not going to actually give anyone credit.
Look at that headline right there, folks. Look at that headline. S&P utility sector coming off its worst day since April of 2020. That's crazy, man. Like, who would have thought utilities would be getting hit this hard, right? But remember, what's the investor base of utilities, right? And utilities are obviously electric companies, water companies, those sorts of companies, right? Who's the investor base? Think about this, right? Like, who goes and is like, I'm going to buy a utility stock? I'll tell you who. It's the people that like those dividend yields, right? But obviously the game has changed over this past year. Now no one cares about dividend yield because you can get 5% at the bank. You can get 5% on treasuries. So suddenly, to get 5% on a stock from a dividend yield, a lot of people don't like that because they say, I'm taking a risk, versus have my money in the bank guaranteed up to $250K, right? Or maybe bigger numbers than that if the government is supposed to back everything, right? So, little food for thought there. And so utilities are still in a tough place, probably will remain in a tough place for the next little bit of time. Short term, they'll be in a little tough place. They'll probably start coming back to life at some point in 2024, in my opinion, because you'll start to see some early folks start to pile in, assuming rates will start going down end of 24, 25.
And I think you'll be better off when we come through it timing, as we were talking about, Joe, is it 1 month, 3 months? We're going to get the talk of, oh God, now we're going to go to stagflation. How's the rest of the world going to do this? But I think you're going to see some of that happen. And I would say put money to work in some of these beaten down stocks and sectors, because you want to do this when they're out of favor, not when, hey, now we're in a slowdown. These are the stocks to go to.
I love you, sir. I freaking love you. Exactly. That's the hardest part of the stock market for most people to wrap their heads around. You got to buy these stocks when they're out of favor, when no one wants them. So no one wants dividend stocks right now. What should you be doing? Think logically, right? You should be buying dividend stocks. Great dividend stocks that have great earnings profiles, that, have great proven business models, that have the balance sheets that are, going to get through any sort of storm. Like, that's what you should be doing right now, right? Always think, like, what does no one want a piece of? And that's where I need to go. Last year, certainly it was growth stocks. You should have been buying Amazon last year. Should have been buying Meta last year. Should have been buying Tesla last year, for instance, right? In the beginning of this year. And Apple and Microsoft, and we can go down the list. NVIDIA. NVIDIA was $110 last year. It's $400+ this year, right? AMD. Shopify, Netflix.
It's October something. What did I say this morning? Second, third? What is
third,
it?
The third.
It's the third. I mean, the teens, the Ides of October, and it wouldn't be surprising, given that we've been in a pretty sustained consolidation, whatever you want to call it, since the first week of August, Sarat. Do you think there's a buying opportunity coming up in the next 2 weeks? I know you're not a tops down guy, but do you think that it's going to be another one of those Octobers? The Dow, it's up in the morning. It's all down almost every day, it seems like.
I mean, started strong yesterday. Could we get that crescendo, that kind of October that we normally get? Probably. We also are going into tax lot selling season. So
True.
You're going to get a lot of window dressing. You're going to get investors, especially professional investors, looking at stocks that were down for the year, either selling out, doubling up. So you add that to the mix.
Good point.
And absolutely, I think this is where you say, hey, where are some good quality companies that have been sold off? I'm going to pick them up because other managers are doubling up, selling off. We do get into this year end. Again, we talked about, we don't know if the government's going to shut down. We don't know where rates are going to go. Oil seems to be going higher, interest rates going higher, and we have global uncertainty. So opportunities, absolutely. But you have to have a strong stomach for it.
All right.
I freaking like that guy. I like that guy. Oh, man. He's got to be one of my favorite people I've seen on CNBC in some time. I liked him. He brought up an amazing point toward the end of that video. It hasn't even been something that clicked with me until he said it right there. Thank you for him bringing up that point. You know what he just said that was so important? He just said tax loss selling, right? Guess what? These dividend stocks have been getting wrecked this year. So you're likely going to still see some more pressure on them, not just from like the whole, well, maybe people are switching out of those dividend stocks for savings accounts or treasuries or any of that. From the perspective of, let's say you got a gain over here, you sold Meta for a big gain this year, nice, okay, or Nvidia or whatever stock, but you got some dividend stock that has done absolutely horrible. Well, go ahead, sell out of that. Take your loss in the dividend stock, right? You can buy it back at some point in 2024 when maybe dividend stocks are more in favor, and make your move that way. And then, basically it offsets your Nvidia gain or your Meta gain that you sold for. So that's going to be probably more selling pressure on these divs into year end. And so, which doesn't give me extreme confidence that necessarily the divs are coming back this year. It's a potential they could start coming back this year, but I'm really thinking in regards to these div stocks, I think they're going to start coming back in 2024 at some point. That's my personal opinion. Ed Yardeni expects 2024 to be a strong growth year. Okay, let's get a little bullish, Ed. Let's hear what you have to say.
Stocks, Ed Yardeni of Yardeni Research. Welcome back. It's good to see you.
Thank you, Scott.
So I just read what Marko Kolanovic over at JP Morgan said, and I just want you to address two things. Rates are high and restrictive, and valuations expensive. Disagree?
Well, the bond yield is actually back to where it was before the great financial crisis. We had this great abnormal environment between the great financial crisis and the great virus crisis. And now the bond yield was trading around 4.5%, 5% in 2003, 2004, 2005, and 2006. So I think we're back to normal. We've normalized the bond yield in the past 3 years, and the economy has withstood it remarkably well. So I'm not convinced that the economy, I think the economy itself is showing that it's resilient. So from that perspective,
Yeah, but Fed lags, Mr. Ed Yardini. Fed lags, okay, Fed lags.
I'm not convinced that these rates are going to crush the economy.
So that was in part of what one of the guests just said as well. And, you know, we're back to normal. I'll give you that. 5%,
Okay.
as I said, like 5 minutes ago, it's not like it's the end of the world. But Ed,
Exactly.
we were at zero forever, okay?
That's
Theoretically ever, you know?
Right.
And now we're at 5%. That's a jarring transition to do in
Absolutely.
a reasonably short period of time. So I think
Yeah.
it's somewhat unfair to just say, well, we're back to normal because 5% is
Right.
where we were before the financial crisis.
No, it's a very good point, Scott. I've been arguing that the economy is in a recession. I've been making that argument since the beginning of last year. I've been calling it a rolling recession. And certainly the surge in mortgage rate certainly has created a recession in the housing market. But to be more exact, it was a recession in the single-family housing market. And now that actually looks like it's bottoming as the multifamily housing market's taken a dive because rent inflation has come down a lot, which is great for the inflation outlook. But I tell you, Scott, these rates are going to kill a lot of projects in the commercial real estate market. We have people who are in that marketplace as accounts managing distressed asset funds. And on the one hand, they're very happy to see all these distressed assets that offer great opportunities for them to turn around. On the other hand, they own some of these assets that they bought with record low interest rates. And now as they have to refinance them, the math just doesn't work. So I agree there are problems out there. And I'm not saying that everything's hunky-dory. I am saying that the economy on balance has been remarkably resilient.
Sure, but you just mentioned, you ticked through where we've seen recessions and what, okay, give you that, rolling
Yeah,
recession.
so the devastating part, folks, the devastating part could be when you get rates obviously very high, which is what we have right now, and we're talking about in terms of big projects. And then on top of that, you could get recession on top. If you get recession on top, plus high rates at a given moment, then you're talking about several years of kind of like a bad situation when it comes to big spend, big projects, anything like that. Because people look out there and they say, okay, interest rates are high, economy's getting weaker. Like, why would we do this big project right now? It doesn't make sense, right? So that's something obviously you saw in the great financial crisis and took years to kind of work out of that and get like big projects started again, right? Those kind of didn't get rolling, even though Fed dropped interest rates down to zero in 2009. You really didn't start to see many of those projects start to come to fruition until 2011, 12, 13, and then moving on into future years.
We can understand that concept, but there hasn't been a recession in what is, I think, without question, the most important area of the economy, right? And that's the consumer economy.
Consumer.
Now,
Yeah.
what happens if that happens, right? The consumer,
Well,
do
if that
you
happens,
actually believe
yeah.
that the consumer can hang on to the degree that it has?
Well, you mentioned some of the headwinds that the consumers is facing. The student loan issue, of course, is a big issue, and so-called excess saving. I think what's been missing in the discussion here is that there's still a lot of assets that have been accumulated since the beginning of the pandemic. The net worth of the household sector is up to $150 trillion, all-time $155 trillion, all-time record high. And Scott, half of that is held by baby boomers. Many of them are retiring, and guess what they're going to do? They're going to spend that. So you talk about excess savings. The baby boomers have saved for retirement, and they have a lot of money to spend.
You believe earnings estimates are where they...
Yeah, that's true. But let's think about that for a moment, right? Certainly when it comes to, let's just call it older folks in general, I mean, they just don't spend the way younger folks do, right? You spend on a whole different level when you're, say, somebody in your 30s and you got kids and you got a family and, it's just a different level of spending versus somebody that's 78 years old. It's just, they're not... a 78-year-old's just not nearly as inclined to go spend money and do this and do that like the 30-year-old would be, or certainly a 20-year-old, right? That's a whole different ballpark. They would just blow through all the money if they had it, right? So I do think that's something to kind of consider there. And I'm just trying to think about that a little deeper. But at the end of the day, you know who that does benefit? If you're going to talk about the baby boomer wealth and things like that, it does really benefit things like cruise lines, to be honest, which I'm not investing in any cruise lines right now. I have been looking at CCL recently and thinking about getting back in that one. But, baby boomers definitely going to love to go on cruises, and older folks in general. And that's, an industry where if you want to talk about people spend, they love to spend on cruises and travel, right? And cruises always seems like one of the most common, because I certainly kind of like my second home was Sun City West. I was always around retirees because both my parents worked in like retirement communities, age restricted communities and things like that where everybody was 55 and up. And my gosh, like the amount of, their customers that would go on cruises all the time was ridiculous. So that's just always a booming industry for, let's just call it folks that maybe are a little older in general. Certainly restaurants can get some nice spending as well. All right, let's get back into this.
Should be for not only the remainder of this year, Ed, but as we turn the calendar, which is not that far away, into 2024?
Well, Scott, I've been at the high end of strategists and kind of more consistent with the analysts, recognizing that the analysts have a tendency to be too optimistic. But I'm expecting actually that this year is going to be 225. The analysts are expecting 220. Other strategists have been expecting much less, some at 185. For next year, I'm forecasting 250. The analysts are forecasting 245. Analysts have recently been actually raising their estimates. Looks like the profit margin has turned. Looks like things are actually getting better on the profits recession, which was all due to a shrinkage of the profit margin. I think the profit margin is starting to improve.
But I'm sorry to interrupt you, but that says unequivocally that you believe that the economy is not going to slow any more than it already has shown that it might. In fact, you can't believe that if you have even more optimistic earnings projections than the street.
Well, just because my numbers are more optimistic doesn't mean that's not consistent with an economy that's growing. I do think the economy is going to be growing next year.
No, that's my point. That's my point. You can't possibly believe that. Forget recession. Forget that. But you can't possibly believe that the economy is going to slow at all from here forward if you have those lofty of projections.
Correct.
I guess that's my point.
Yeah, quarter to quarter there can be volatility, but yes, I'm expecting that the economy will continue to grow through year end. I don't expect it's going to keep up what we saw in the third quarter, which looks like it's going to be 4 to 5% real GDP growth. Maybe we'll get something less than that. I'm sure we'll get something less than that in the fourth quarter, especially if the auto strike lasts a while. I can't dismiss the possibility there'll be a negative quarter in the fourth quarter if the auto strike lasts through the end of the year. But that's not what I'm anticipating. I'm expecting that there will be a settlement. But going into next year, I think next year will be a growth year. I think the consumer will continue to have employment gains. I think real wages will be increasing. I really think that the big kind of secret sauce in this whole thing is going to turn out to be productivity. I see evidence that productivity is starting to make a comeback. And I think it continues to make a comeback into next year and the following year. So, yeah, I think productivity is going to turn out to be what gives us better than expected growth, better expected profits, and real wage gains.
All right, so there's two things that could be very bullish for us in 2024, okay? Because we can certainly look at the bad side and say, oh, this could go wrong, this is going to go wrong, this is going to go wrong. But you got to look at the other side as well. What could go right? There's two very specific things. One is consumer confidence getting in a much better place. We're still at very bad numbers when it comes to consumer confidence. We're coming back, but we're still in bad territory. If we can get inflation to not be an issue anymore in 2024, which is a realistic potential, there's very much a potential that inflation will not be a problem in 2024. That's going to be huge for the consumer, or for the overall economy, especially if jobs are still there, right? And wages are still there. Then we're in a situation where people start to feel a lot better and ultimately have more money to spend and just are in a better position to either invest more or to obviously spend out there in the economy or do whatever. So that's a factor that could help us. And also small business confidence index has been in a bad place for almost 2 years now. If we can get that to start to improve, which once again, I think that goes back to inflation not being a problem, then we're talking about, some brighter skies and some better days ahead, okay? So just some things to consider there. Alrighty, now let's talk about bonds, what's going on here. This is extremely important. Everybody pays close attention to what they're going to be discussing in this video, because I'm telling you this has ramifications for the economy and for, let's just call it the stock market.
percent declines in bond indices in just the past several weeks to appreciate the risk in risk-free treasuries. When rates move the wrong way, losses can mount in a hurry. We talked yesterday to some of the biggest bond fund managers about how to manage the risk and what factors bond investors need to be watching. So PIMCO CIO Dan Iverson tells me his risk list starts with the idea that inflation is still a material risk. Debt levels are very high. Some investors are demanding default or downgrade premiums. The economy has been strong, and that could push up rates further. You guys were talking about just this stuff in the 6 a.m. hour. All that has been behind the recent sell-off, and he doesn't have tremendous confidence those risks have entirely played out. But Iverson is recommending investors look to extend somewhat the average duration in their bond portfolios. He's taken the duration of the PIMCO Income Fund with lots of billions of dollars in it up to 4.7 years. Still low, but the highest it's been since 2014. All of that points up a risk that many sitting in cash and short-term bonds may not have thought about. Rollover risk. Those juicy money market yields, they can disappear like that if the Fed starts to cut, leaving investors with the risk of reinvesting at maybe lower yields and wishing they'd locked in the higher ones. I talked to John Krog, head of Vanguard's active fixed income products. He tells me a decision to be all cash or meaningfully overweight cash relative to your long-term allocation is a call that's reliant on you and your advisor being able to reallocate towards your long-term equilibrium asset allocation. In other words, staying short is market timing. It's a call on timing. Krog says better to make some of those choices right now while bonds are cheaper. Put a portion of the portfolio in what they call the belly of the curves, 3, 5s, and 7s. While there could be further losses, they're only losses if you sell. Krog says the biggest risk is the behavior of investors who abandon their long-term strategy because of short-run fears, and they realize losses instead of riding them out.
Silicon Valley Bank shit. If you had gone into a 10 or 15 or
right then
at 3.5, you'd already be looking at 80, probably at 70 cents on the dollar. So we understand that there's reinvestment risk if you don't go long. Everybody knows that. But if you had gone in the last year, because we're at highs now, we're at yearly high, you're down on every single long bond you bought. You're down right now.
That's true.
It definitely cuts both ways.
It does.
And there's no upside. There might be a little upside. Why would they cut, though, Rick? They're not cutting anytime soon.
Yeah, I really don't see the cut. Now, I know we can look at Fed fund futures and we could draw different conclusions, but I've been a big advocate that if you look beyond 1 or 2 meetings in Fed fund futures, you're really more into a fairy tale than a reality, and I think you need to pay attention to how much change can happen. They're just markets, Joe. It's a fancy 1-month T-bill market, and it changes a lot. One thing I'd like to point out, Steve and I were discussing in the green room, if you look at the spread between our rates and German rates, it's some of the widest of the year, and we're going to continue to exert a force overseas, bringing their rates higher because everybody, of course, looks towards the U.S. Treasury market.
I guess we didn't realize what we had when we had 7 and 8%. Then we had it forever. We had higher than that, and nobody got excited. No one.
There were guys on the street who would tell me that they would be like 10 years after, the Volcker years.
The band?
They would be looking at the portfolio and see a bond there that was like a 12 or 13% bond. They'd be like, what is this one doing here? And because they hang around for a while. And there were times when you could really be clipping coupons and put your feet up and you could retire. It's tougher now, but these are somewhat better yields for retirees. Right now, this is a bit of a gift to the baby boom generation for having done absolutely nothing.
It's a lot worse if you got to lock it in.
You got to lock it in. And I really just want to redirect to what this guy was saying. You are not Rick Santelli out there. You do not understand the bond market the way he does, because he does prices and change in his sleep. His wife complains to me about the idea he's talking in his sleep about the change. You are not an expert. You have to think about, sit down with your advisor and say, here's the money I need over X amount of time, and here's the duration that I can live with. Maybe it's a portion of 6 months and 2 years. Maybe there's some 3s, some 5s, some 7s in there. Keep the duration short, but don't have no duration. And yes, you will have losses if all this stuff goes the other way, like Joe was talking about, but some of it is offset by the short end bond, and some of it you ride out instead of selling.
Ridiculous comment. Well, you get your money back if you hold it. I mean, you're going to be underperforming for 10 years. If rates continue higher. And what are you doing calling his wife? And did you know that he's been calling your wife and talking to you?
She's calling me to complain.
I see that red light blinking on the answering machine a lot, and I start to wonder.
But
Dang, red light blinking on the answering machine. Talk about your age showing. Holy smokes, man! Who's got an answering machine nowadays? What is going on?
It's like, yes, you're
No,
right.
I do, but the idea that, hey, it's going to mature someday. Try that with a 100-year bond. I mean, that.
Well, especially if you think, I look at my monthly charts, and if things move in a certain direction, if markets set up in a certain fashion, I do think 13% would be my 10-year call.
Yeah, why?
So,
what gets you to that number? Because that is a shocking.
Where's that number
No,
from?
it is a shocking number. What I do is I went back to 1980.
Yeah, that was shocking. I don't know if you guys heard. This man right here, Rick Santelli, yesterday was on Fast Money, and he was mentioning something about rates going to 13% over the next few years. I was like, what? Excuse me, sir? 13%? What are we talking about here? Yeah, that's why Becky Quick's like, wait, what were you talking about yesterday? 13%?
Why? What gets you to that number? Because that is a shocking.
Where's that number from?
No, it is a shocking number. What I do is I went back to 1980. 10-year note yields peaked just shy of 16% in September of 81, and I did some cycle updates. And if you look at, there's basically like a 6.5, 7-year cycle that could bring us into double-digit rates. What would be key there is we would need to close above 7% in the next 2 years.
So
if that happens, it would signal the next move, which would be more aggressive.
That's technically, but fundamentally, what we'll call that?
That's easy.
And the only way that happens, let's be very clear, the only way we get to 13% someday is the economy stays hot for years to go in the future, and honestly, too hot. And we have unemployment extremely low for years to go in the future. That's the only way that happens, folks, just to be very clear about that. There's no scenario where you get a recession, a big recession, or anything like that, and it's like, oh, yeah, we're still going to 13%. No. Then we're going back to 0%.
Look towards government.
200 debt to GDP.
Yeah.
We got no way. We got to print so much money.
Military budget and servicing the debt right now, or fighting it out to see who's in the lead. Imagine what that's going to look like in 2 or 3 years.
So MMT doesn't work?
Well, it worked fine if you were a Democrat and you liked to spend, but it didn't work fine for everybody else.
This is what I was worried
the
about
bills.
with you two sitting.
It worked and works, and the whole concept behind any reasonable, rational thought about MMT is the following. When your growth rate is above your interest rate cost, then it pays for you to go ahead and invest in stuff that has a return. And what is the return? The return is the growth rate that is above your interest rate cost. We are not there any longer, or we're about even, depending upon where you want to put nominal.
Where does the government actually get the R for return, though? That's the part I'm
The R
missing.
for return are roads. The R for return is health. The R for return is...
Didn't we get those in the
It's
50s
education.
and 60s and still have surpluses?
We didn't have surpluses in the 50s and 60s. We had surplus
because of the war.
Right,
Yeah,
because of the war.
you're right.
But no,
A better fiscal
the return
picture.
is defense. The return is all kinds of things that government does that are a positive amid tremendous inefficiencies, amid all kinds of reasons to roll your eyes because it's the government. At the same time, you look around the world and you say, well, where would I rather be living? America's
Well, I don't
not a
know.
bad
Listen,
place.
I agree with you, and I take it back.
And
it's
part
not
of it's the
just the
government.
Democrats, actually. It's both sides of the aisle. How disappointing are both sides of the aisle?
Yeah, the traditional Republicans are definitely not happy with kind of some of the stance their party's gone on over time. But anyways, it's a subject for another day.
I don't know. I just
Steve?
It used to be one, try to be really tight with the money, and then the other would try to be looser. But now it's getting more confusing in recent times. It almost seems like both sides are looser. So that's, weird times, folks.
Look, I am not disappointed when government works.
But they're doing things that...
It's an oxymoron.
I mean, you look at the way they're involved in our lives. You really think that's worth the money that people are spending? It's an inefficient way to spend tax dollars.
Which part of it?
All of it.
Which part? No, all of it is not acceptable.
Okay.
You gotta give me something.
If you're really going to yell, I'll let this keep going on, but I don't think it's not.
No, we're not going to solve
getting
anything.
anywhere.
In the
We're
end,
not.
$33 trillion in debt, Steve. When our kids are paying
we
70
agree on
cents
that. We
on
agree
the
on that.
dollar
And
for their taxes in about 10 years,
I agree
then
on
you
that.
talk to me.
And I am very, as I said yesterday, very disappointed in Janet Yellen and the Treasury. I think they should have done a better job. She should have done a better job at trying to rein in the spending, and they should be working to have a plan. Now, we had Jared
They should have
Bernstein.
issued some long bonds a couple of years ago, maybe a lot more.
I think that's one issue but then you'd have Rick complain, or people who he talks to complain, that you don't want the government gaming or timing the market.
No, he just said he wanted to do it.
Is that what you wanted? really?
I don't really like the government trying to time the market, but I
Right.
think that the alternative might have been worse.
Oh man! So, anyways, that was entertaining, man. That was freaking entertaining. They need to have Rick Santelli and the other Steve Leisman, I think his name, Steve Leisman. They need to have both those guys on more often, man, and have them argue. I think that could have been really, really intriguing. I wish they would have let him run, because that Rick Santelli, man, he can get loud. He can get loud and whew. So, anyways, guys, appreciate you joining me as always. Thank you so much for being here. Thank you for being subscribed. The last video, I knew it was going to be a good one. Sure enough, it was. So, appreciate y'all joining me and sticking around for that one. Also, if you're in your first 3 years of investing, I got a free workshop for you. This should help you out tremendously. It's like a 5 days worth of videos, and it's absolutely free to access that. That's pinned comment down there. It's called Investing Foundations. It'll help you out tremendously. Much love and have a great day.